today we begin with the federal government's decision to suspend the planned 15% import duty on petrol and diesel, a move that comes barely weeks after it was approved by President Bola Tinubu. The Nigerian Midstream and Downstream Petroleum Regulatory Authority (NMPDRA) says the government is no longer considering the policy, which had been slated for implementation of November 21, 2025. Now the import duty was originally intended to protect and encourage local refineries such as the Dangote refinery by making imported fuel costlier, while the reversal may provide temporary relief to consumers and transporters. It raises questions about the federal government's policy consistency and energy sector strategy, especially as Nigeria seeks to balance local production with revenue needs. And to help us unpack this, I'll be joined by a financial analyst who is also an economist based in Abuja to help us understand what this policy reversal means for Nigeria's economy and the refining sector, as well as the consumers. Welcome to the program, Mr. Jeremiah James.
Thank you very much, Ms. Walter.
Good to have you here. Okay, let's get straight into it. So what's your assessment of the federal government's decision to hold this 15% import duty? I mean, does it reflect responsiveness to economic realities or uncertainty in policy direction?
Okay, so halting the 15% import duty on petroleum products reflects responsiveness to current economic realities more than policy uncertainty. With inflation already high and food costs driving up living expenses, imposing such a duty now would have worsened the situation for households and businesses. The decision shows short-term economic sensitivity aimed at preventing further price shocks and maintaining market stability. That's majorly it.
Okay, that's quite an interesting perspective. You've highlighted some valid points there, especially how the suspension reflects both responsiveness to public pressure and the need to stabilize prices in the short term. So looking at that balance you mentioned between protecting domestic refineries and shielding consumers from inflation, how can the government realistically achieve it without hurting one side or the other?
Okay, so the government can strike the right balance by adopting gradual, well-sequenced reforms instead of abrupt tax measures. One, we can face in tariffs only when local refining capacity can meet national demand to avoid burdening the customers. We can also offer targeted incentives such as tax reliefs, cheaper credit and infrastructure support to domestic refiners rather than relying on import duties.
Okay, let's go to another perspective, which is on the Nigerian stock market. Recently, they've witnessed its most single-day drop in 15 years. The all share index fell by 5.01%, wiping out over $3 billion from investors' wealth amid massive sell-offs in the blue chip companies like Dangote Cement, MTN Nigeria and Boa Cement. Now, only 4 stocks managed to close in the green as the sell pressure dominated the day's trading. Market capitalization slipped below 90 trillion naira mark, closing around 89.88 trillion naira, while trading volume surged by over 80%, showing how active yet volatile the session was. On this steep 5% drop and the heavy sell-offs in big names like Dangote, as I mentioned earlier, what do you think were the main triggers? Like, what are the causes to all of these concerns I just mentioned?
Okay, so the pronouncement of 5% drop in the Nigerian exchange group all share index and the widespread liquidation of large cap stocks appear to be driven by a combination of macroeconomic pressures, monetary tightening, and investor sentiment shifts rather than any single corporate event. And to throw a little light on maybe the first two I mentioned, which is tight monetary policy and liquidity constraints. The Central Bank of Nigeria sustained tightening stance to control inflation, also uh, the exchange rates resulted in elevated interest rate. Then the second, which is exchange rate instability and foreign investors retreat, persistent volatility in the naira and uncertainty surrounding access foreign exchange have discouraged foreign portfolio investors. So those are majorly the drivers of the drop from my perspective.
Okay, thank you for that perspective. Let's go on to another issue, which is on the market capitalization plunging below 90 trillion naira and trading activities spiking. What does that tell us about the overall health, I beg your pardon, and resilience of Nigeria's stock market? Should we see this as a temporary correction, or could it point to a deeper structural weaknesses in market?
So the fall in market capitalization below 90 trillion naira, despite recording trade volumes, provides a dual narrative. One of immediate stress, but also the second of considerable market liquidity and resilience. From an analytical perspective, I could see short-term correction and a potential structural evaluation. Why did I say a short-term correction? The rapid price decline, accompanied by heavy trading volume, is characterized of a technical correction rather than a systematic downturn. Then that of the potential structural revaluation. However, should the downturn momentum persist beyond current valuation ranges, it may point to a broader structural shift in how investors price risk in Nigerian equities.
Okay, finally, looking ahead, what should policymakers, regulators, and investors be doing to restore market confidence? Do you see any short-term opportunities that strategic investors in Nigeria might take advantage of while prices are still down?
So, restoring investors' confidence in Nigerian capital markets requires coordinated policy responses and decisive communication from both monetary and capital authority. And then some of the measures that can be put in place, as I've mentioned, uh, what some of the this in earlier, it's to enhance exchange stability and transparency, also to strengthen policy coordination, to also deepen the market infrastructure and governance, engage and reassure investors. With all these measures taken, it's going to, reinstate the confidence of foreign investors and also local investors in the economy.
Okay, it's certainly a critical moment for Nigeria's financial market, one that raises questions about confidence, regulation, and economic stability. We'll keep tracking how the story unfolds and what it means for investors at home and across Africa. Thank you so much, Mr. Jeremiah James, for joining us.
Thank you very much. It's a pleasure.